2 minutes. Are you people ready for that quiz?
Yes, sir.
Okay, so just give me 2 minutes. I'm just put the finishing touches on that quiz. And meanwhile, I hope is Tanya coming today?
She was there in the meeting, but I don't know why she left.
Achha.
She's trying to join. She just messaged.
Okay. You're the co-host, na, Shruti?
Yes, sir.
So let her come.
Good evening, sir.
Good evening, Tanya. Just a minute. Just give me 1 minute and I'll be with you. I'm just trying to complete this quiz. And by that time, what I suggest is you people have a look at that FPWM chapter so that you're all ready. Paresh ji, good evening.
Good evening, sir.
I hope you're all ready for today's quiz.
No, sir. I am not prepared, but okay, I will try.
Okay, fine. I will. So what we'll do is we will start with the Kahoot. Is that okay?
Yes, sir.
Okay, then I am starting it now. And I'm just sharing the screen. I hope you can see the pin, all of you.
Yes, sir.
Okay, then I'll start. All three of you are here. Actually, each of you have opted for a different stage. Very interesting. Sorry, guys, there's a mistake here.
Yes, sir, the question is itself written in the.
Okay, just take risk tolerance and let's finish this. Excellent. Each of you have chosen one. It's something I don't understand. How is it that Paresh ji, you had 15 out of 20, but somehow Shruti is the winner. How is that possible?
So it's a response. fast response. I think that also counts.
That counts, but it's unfair.
It's okay.
It's like saying if someone answers a question fast in an exam, even if he gets it wrong, the examiner will still give the highest marks. Tanya, you need to have a look at your answers. You must understand where you are making the mistakes. Huh?
Actually, sir, while choosing the answers, some of the I have not revised also, it's my fault. Sir, but in some of the answers, when I was choosing it, automatically get ticked up.
Okay, fine.
So
But
one
have a look.
question.
If there is one answer of your all three of you which really I liked was that question regarding so what is the proper frame of length of time to get a good return in equity, and all three of you have picked the right answer, which is 10 years or more. Recently, a few days back, I was listening to another audiobook, this time on investing in equity, how to make money in equity. And this author wrote this book in the 1990s. And he was basically writing in the context of the American share market. And he writes in that book that you should think in terms of a time frame of at least 20 years. Not at least, he said, if you think in terms of 20 years, then in that case, there is no way in which you will get a low return. You will always get a high return, because during that period, whatever crashes takes place in the market, whatever happens, ultimately you're going to end up with a very, very good return. And I think that is correct, very, very correct. But then the other side of the picture is that 20 years of patient investing is again a very, very difficult thing. See, I think Paresh ji, if you have ever invested a little have you done a bit of investment in stocks, Paresh ji?
Yes.
So you know this, if you invest in a stock, and even if you know it is a good company and everything is fine, but once that stock gives you a 10-20% return, the temptation to quit the stock and book your profits is very high.
Yes, right.
You will not try to hang on for 20 years. Even though if you do manage to stay for 20 years, probably you will get 5-10 times the original in a good company, whatever you had invested. But most of us do not have the patience to actually do that. But today we have a very nice topic. So we are now moving on to mutual funds.
Excuse
Yes, Tanya.
Sir, you talked about stocks and that all things, sir. Would you like to take one session on the stocks? What is how to invest on it?
We'll come to that. No? After this, after mutual funds, the next is equity.
Yes,
so we will reach that equity part. But the thing in stocks, Tanya, is that it is an asset class which does not have a linear growth. That means you will not always find that stocks will continue to rise like this. It will go like this.
Basics concept. Stock में कैसे invest किया जाता है, कैसे पैसे उसमें बनाए जाते हैं. Sir, about that.
Patience उसमें चाहिए main. पैसे कैसे बनाए जाते हैं उसके लिए, like there is that old saying, time is money.
Yes,
correct?
Sir.
Now,
yes.
Time is money का normally meaning ये होता है कि अगर आप किसी का वक्त बर्बाद करते हैं तो उस समय में वो कुछ अपना बढ़िया काम करके वो पैसे कमा सकता है.
Sir, like there are many things in that pumping and dumping method and all that.
हाँ.
That all things we need to learn.
Pumping and dumping is illegal.
Illegal.
Yes. We'll explain those things.
M curves, pumping, dumping. What? Like I'm hearing a lot of thing about it. People say that you are an economic student. You are doing finance management. Why don't you know about it? So I told that I'll tell to my sir to teach me.
Okay, fine. Okay, Tanya. We will do this. We will do this when we come to the next unit. Today, of course, we will continue with mutual funds.
Sure,
and try
sir.
to understand that. Okay. So good, Tanya. It's nice that you have this thing in mind. Okay. So coming to mutual funds, first of all, let us just look at this little diagram that I have here. This will explain to you in a visual way exactly what mutual funds are. So look how it works. You start with investors. Now, a large number of investors, what they do is they give their money to a fund manager. That means a person who will be able to take that money, the entire corpus, and he will manage those funds. Manage means he will first of all decide where to invest the funds. Once he has invested in different financial instruments, it is for him to decide how long to wait before he sells the thing, when to churn the stock, when to sell something, buy something else. Those things will come again. And then, so this point is there, he will invest in securities. If the fund manager is correct, it will generate returns. Remember, this returns part is always subject to market risk. So whenever you go and invest in a mutual fund, one thing which they will tell you right in the beginning, right when you start the investment process, is this, that it depends on the market returns. This is number one. And then whatever returns is made is passed back to the investor. That is the profit that the investor actually makes. Okay. So anybody has any views about this? Anything to add? Any questions? This is whatever conception you had about mutual funds. It matches with this diagram. All of you?
Yes, sir.
Okay. So the next thing we have here is advantages of investing through mutual funds. Okay, now I want each of you to tell me at least one advantage. Then I'll begin displaying whatever is here.
Diversification and high returns.
I will take, okay, you say diversification and high returns. Okay, right. Okay, correct. Partly correct. Then next, Tanya. Or Paresh ji.
Sir, fund management by an expert.
Absolutely correct. Absolutely correct. And Tanya?
So we would have a very high returns.
That is actually wrong. That both you and Shruti are getting that part wrong. So I would say that, that question in which was there in the quiz also, okay, why should a person invest in mutual funds? And I had given you 3 reasons. I had spoken about returns, I had spoken about diversification, and I had also spoken about professional management. Now, the first thing to understand is that why do people invest in mutual funds, or why should one invest in a mutual fund? It is because it is professionally managed. No, the logic is like this. For example, Tanya asked a very nice question. Sir, please take a class on investing in equity. Okay, now, since you are now part of this little group of ours and we are discussing these financial planning methods on a weekly basis, it's okay. I can also, I'll find out about equity. I'll give you a small lecture on that. I can recommend books, all that is there. But generally speaking, if a person is not attending such classes and he wants to make an investment in a place which is not in the bank. For most people, the easiest form of investment is you put it in a fixed deposit in a bank, tell your banker, he takes the money from your saving funds account and he puts it in a fixed deposit, and whatever return you get there, you get it. At least it is risk-free. That is one thing. But somebody wants a higher return and he's willing to take a higher risk. So like we were talking about risk tolerance or risk appetite. So his psychological profile is that, yes, I can take more risk. I would love to invest in stocks. But my problem is that I don't know where to invest. Exactly what Tanya was saying. I don't know where to invest. And I don't know whether I should buy the stocks of only one company. Let's say I have 50,000 rupees. Should I put the entire 50,000 rupees in the stock of in the shares of one particular company, or should I take this money and split it up between 5 companies, 10,000 in different companies? Then how do I choose these companies? That's another point which is very relevant. Then once I buy it, when should I sell? When should I sell? What should I do if it suddenly goes down? Now, questions like this, if I were to ask you to list all the doubts that you have about investing in equity, I'm sure you will come up with even more questions of this type, which you cannot answer, or where you have an answer, but you're not sure whether you're correct or you're not. Then in that case, what is the better thing to do? The better thing is that let us give our money to someone who understands this business. And let that person take these decisions for us. Where should I invest the money, stock or bonds? If stock, which companies should I invest in? Which sector should I invest in? Then when should the stock be sold? Once again, that person will take a decision. Another thing about equity is that if you buy equity, there is generally a perception, and to some extent this is correct, that you must continue to monitor that investment of yours quite regularly. So you should actually be looking at what that company is doing, where the share price of that particular company's shares stand on a particular day. Are you making a loss? Are you making a profit? Now, the moment you put your money in a mutual fund, you don't have to think about these things. You have someone who is thinking about this for you. So that is the background, and that is why when a person puts money in a mutual fund, the main reason, and that is why here also you see it begins with fund manager. This fund manager is the person who is actually now taking decisions about your money. So in a good mutual fund, the star is the fund manager. So people invest in a mutual fund when they know that they have a fantastic fund manager. Some of these fund managers are very well known in the industry and they are stars in their own right, because they take decisions on behalf of thousands and thousands of investors, and quite often these decisions are good. They make money. Remember, I was telling you about this Quant mutual fund last time. I think Paresh ji had also read about it somewhere, where that fund had made a profit of 96% in 1 year. So practically speaking, everybody who had bought units in this mutual fund, Quant mutual fund, would have actually doubled their money in 1 year. Now imagine how grateful these investors will be to the fund manager. Here is someone who has taken our money and he has had the wisdom to put it in stocks which did so well. So the first thing to remember is why mutual fund? Because I need an expert to handle my funds. All those tricky questions about equity, which I don't understand, what I do is I entrust this to a professional manager. So the first reason is that. Now, let us look at I have put it here systematically. Let us look at some of the reasons like this. That professional management is definitely here, but let's look at some more reasons. First of all, how many of you, or Pareshji, do you have a phone pay account, or Tanya and Shruti?
Yes, sir, I have.
You
Yes,
have
sir.
you have
Yes.
phone pay?
Yes.
Okay, so phone pay is something. I am opening my phone pay. And if you look at PhonePe, you will find that if you scroll a little, move it up, you will come to a place called investments. Okay? And in investments, you will find that it is possible for you to buy gold, silver, small cap funds, best SIP funds, large cap funds, and even start with a sum of 100 rupees. Now, in a mutual fund, what happens is that you can start with a investment of as small as 500. That means anybody can actually invest in a mutual fund. First thing to remember. Second, like I said, the main reason why people actually do this is it is professionally managed. Here is something which I think Shruti had mentioned: diversification, choice of schemes. So hundreds of mutual fund options are actually available. That's another very interesting thing. This is an advantage. It is also a disadvantage because it becomes very difficult to understand where should I invest. Then liquidity. Can get money back in transaction plus 2 days. So mostly what happens is if you want the money back, of course, like equity, even in equity, it will take you about 1 day. Here it takes 1 more day. But the effective price will be the price at which you decided to actually sell the units on that day. But it takes time to move the money from the account of the mutual fund to your account. Different banks are involved. So it gives you liquidity. In 2 days, you will have your money. And there are tax benefits. So some funds offer tax benefits. And otherwise also, mutual funds will give you, probably you will end up paying less taxes, depending on the type of fund, of course, than maybe a fixed deposit. So that's another point. It is well regulated and low cost, around 2% per annum. You will find many funds which will actually give you the cost there will be even less than 2% per annum. So that's another one. Then transparency. I can look, you can sort of, if you have an investment in a mutual fund, you will have a specific unique ID, your folio number or something. And based on that folio number, it will be possible for you to every day look at what the net asset value of that fund is. We'll understand these words better as we go. What is the NAV of that particular fund? And finally, it gives you flexibility. I want to buy today, I buy today. Like this PhonePe app, if you invest in a fund, it will be possible for you to actually just take out your phone and a few taps on the keys and you will have invested money, subject, of course, to your having the money in your account. So this is one of the big reasons why it is good. Now look at the way it is, the governance structure of the fund. So this is another interesting thing. How does it work? So there is a sponsor. We will understand this also by giving you an example. But so there is a sponsor. Basically, this sponsor is the owner of the business. So you can think, let's say HDFC Mutual Fund, Tata, somebody is the sponsor here. Now, basically what happens is that there is in finance a concept of arm's length relationship. Let's say that someone like HDFC decides to start a mutual fund. Now, HDFC is already a financial institution. It's a bank, and or let's say it's a housing finance company, and it's in the business of taking money from people, giving money to other people. So if it gets into mutual funds, where is the guarantee that it will not divert money which is received by it for the purpose of mutual fund investments into its main business of giving housing loans, let's say. So the law says that you have to maintain a arm's length, a certain distance between yourself and the mutual fund that you are sponsoring. So what happens is, how do they do this? They say that you will not manage this asset management company. This is the company which will manage. So let's say that we have Tata here as the sponsor. So Tata will not manage, it will be managed by an asset management company. And this asset management company will be looked after by some trustees. So trustee is a person who is taking the responsibility of actually governing the mutual fund. They will look after everything. Are the managers in the AMC taking the proper decisions? Are they doing? Basically, it is most interested in ensuring that the mutual fund or the AMC functions in an ethical way. It does not divert funds. It sticks to the core objective of investing in a certain type of stock or in a certain type of bond. Whatever it is, it will ensure that that is done. That is the job of the trustee. If these people are not doing that, if they are, let's say, diverting the money or not following the path which they had told investors they will follow, then in that case, the trustee is supposed to step in and protect the interests of the investors. So no matter who is the sponsor, the trustee will be a person who will, on behalf of the sponsor, look at the way the asset management company is actually being run, and they will also protect the interests of the investors. Have all of you understood that? Any questions? All very quiet today. Anybody?
No, it's okay, sir.
It's okay, fine. Then, of course, there are other players. There is the depository, the registrar, the transfer agent, the auditor. We need not get into that much detail. So basically, remember, there is a sponsor. This will be the name which you are familiar with, ICICI, HDFC Mutual Fund, Kotak Mutual Fund. That person is here, sponsor. Then this trustee and AMC are actually behind the scenes. You don't really know about these people. They are behind the scenes. They are actually looking after the entire the mutual fund as you see it, but they are वो एक तरह से पर्दे के पीछे हैं. वो आपको दिखते नहीं है, लेकिन वो हैं. So that's one. Then we come to the same thing. Now you understand it like this. So this is the 3-tier structure. There is the sponsor, there is the trustee, and there is the AMC. The sponsor, they are the persons who will think of this idea of a mutual fund. And before they can act further, they must approach SEBI for registration. So let's say that HDFC or Tata or ICICI has thought that we want to start a mutual fund. What they will basically do is they will think about this idea, and then they will apply for registration. What they will then do is they will form a trust. The trust must have a board of trustees. So these will function like a board of directors. And it is the responsibility of the trustee to ensure that the mutual fund operates as per the regulations of SEBI. Both members may not, members may not engage in the day-to-day So the board of trustees will not engage in day-to-day operations of the mutual fund, but they will definitely be there to see that the fund maintains the direction that it was given. And the legal structure that the legal entity that is actually the mutual fund is the asset management company. The assets are basically, what are the assets that are being managed? The assets are those investments which the mutual fund has made. So they may have invested in equity, they may have invested in bonds, whatever they have invested in, those are my assets. So that asset management company is managed by managers. Those managers, their work is overseen by the board of trustees, and the board of trustees are ultimately the person standing between the sponsors, let's say Tata or HDFC or ICICI, and the investors. So this is how the legal structure is. So here is an example. So Tata Mutual Fund, there is a joint venture between Tata Sons and Tata Investment Corporation Limited. They are the sponsors. They formed this company, the Tata Trustee Company Private Limited. So even though the word Tata is here, please understand that these Tata people are not going to be listening to Tata Sons and Tata Investment. They will make independent decisions which are based on the SEBI guidelines and which will protect the investors. And they will also oversee the asset management company. So in this particular case, Tata Asset Management Company Limited, this is the legal entity that has been formed. The Tata trustees are looking at this, and the sponsors are Tata Mutual Fund. The same structure you can see is here in ICICI Pru Mutual Fund. So it is a joint venture between ICICI Bank and Prudential Private Limited Company of the UK. They form ICICI Pru Trust Limited, and they in turn start this company called the ICICI Pru AMC, and the AMC is actually managing the fund which is created. So this is just so you understand how a mutual fund actually operates. What is the way it is governed? Kaise chalta hai? So it's because, mutual funds are managing thousands of crores of rupees from, in fact, millions of investors. So it's a huge responsibility which is there. And how exactly does it work? Why are these investors not cheated? This is the structure which essentially has been designed by the regulator and which makes sure that everybody is happy with the working of the fund. Now, the next thing here is, what are the disadvantages of going to a mutual fund? Any thoughts here? Anyone?
The risk is more as it fluctuates with the market, so uncertainty is there.
No, but that part, that uncertainty, it depends on which type of fund you actually go with, Shruti, because it is possible for you to choose funds which will invest in instruments which are not so volatile. So maybe you will have a fund which is investing entirely in bonds. It is so when we say disadvantage, maybe that word is not so correct, but from an investor point of view, okay, let me ask you this question. Suppose you have some money today and you want to invest in a mutual fund. Where will you invest it? Anyone can answer that question. Which mutual fund will you choose?
Sir, actually, I think brokerage charges, we have to pay the brokerage charges. That may be one of the disadvantage. And selection of proper mutual fund is very tricky actually.
Exactly. See, Paresh ji is saying something from experience. It is very difficult to select. There are 100 funds. Which one should I invest in? And see, when we started the process of deciding to invest, we first acknowledged that हमें आता नहीं है भाई, ये इस गेम के रूल्स हम लोगों को पता है नहीं, or iske liye let's go to a mutual fund. Like the moment you take this decision, you have another big decision, which mutual fund. And I feel that that is the first disadvantage of the mutual fund process from an investor's point of view. See, each mutual fund is functioning with certain rules. They, as you know, as we go through this presentation, you will get a very good idea about how many types of the different types of mutual funds that are there, even though I am not saying that I am giving you everything, but you will have a very good idea about the larger part of the industry. But then which one do I invest in? This is my biggest problem. So there are so many different types of mutual funds that it's not easy to decide first. Then there is another very big problem. It is very difficult to evaluate the performance of a mutual fund. Why is it difficult? Because see, when we look at performance, so I've asked this question, how do you evaluate the performance of a mutual fund? Anyone? Pareshji, just wait till Shruti and Tanya, if they have any ideas, let them say first and then you say anything you want. Because possibly you may have a better exposure to this. Shruti, Tanya, any thoughts on this? How do you evaluate the performance of a mutual fund? How do you know which is good, which is bad?
Sir, no idea.
Okay.
By
Good.
looking at the previous records, financial statements?
Financial statements, no. Financial statements of the mutual fund, you will only get very vague figures. It will not really help you in understanding the performance part. The financial statement will only tell you that, okay, during the entire year, these are the assets they had, these are the liabilities they had, these are the expenses they had, but it will not ultimately, the financial statement, Shruti, is more, who is more interested in this? The board of trustees, the sponsors, they are the persons who are more interested in that. As an investor, you are more interested in something else. What was the increase in the NAV of that fund? See, think of it like this. You are comparing the NAV. NAV, for the moment, just understand it like this. It is the price at which the units are bought or sold. So when you decided to buy a mutual fund, then you decided to invest, let's say you decide to buy 100 units. So what is the per unit cost? If you Google right now and look at the unit cost of any mutual fund, any particular mutual fund scheme, you'll find it is there. 13 rupees 50 paise, 64 rupees 5 paise, something will be there. So basically, you want to understand when you evaluate that if during the past, how much has this price or this NAV grown? What has been the increase? What has been the growth from year to year? Now, the problem is that if you pick any date last year and you compare it with the corresponding date this year, that means exactly 1 year later, you will get one return. Now, if you pick a different set of dates, you will get a different return. So if I pick, let's say, 1st January and go to 31st December of 2021, I will get one return. If I pick something else, let's say I take March 2021 and December 2020, I'll get a different return. So it's very difficult to understand simply on the basis of the return whether this mutual fund is actually going to do very well. And so recently, my son asked me, I want to make an investment in a fund which is basically it markets itself as an insurance product, but it is taking money from you in the name of insurance. It's investing it in different companies, and whatever profits it gets, it will give it to you ultimately as a bonus when the insurance policy matures. So over a 20-year period, they were actually offering, if you give us 1 lakh rupees, sorry, 3 lakh rupees per year for 10 years. So you give us 3 lakh rupees per lakh for 10 years, per year for 10 years, then in that case, you have given 30 lakhs. And after, they'll make you wait for another 10 years. From the 21st year onwards, they will give the money back to you. And they were offering 2 crores. So I used that simple annuity table that we had, which I was showing you in Excel, in which I tried to see what return is this mutual fund actually thinking about. And I was shocked to find that the return which they needed to get on an annual basis to give 2 crores was 18%. Now, the moment you begin to examine these things, you find that it is not realistic. But why is the mutual fund actually considering this realistic? So basically, what happens is that when you begin to look at it like that, then you realize that what they are doing is they are saying that if we look at the past 10 years, then if I take that as my return, then next 10 years, if I get the same return, I'll end up with this 2 crores thing. So problem is that growth rate changes depending on the dates that are chosen. Then the other thing, there is no guarantee that a mutual fund will give you the same growth rates that they had given in the past. Okay. Now look at this. I'm giving you a basic idea about different mutual funds here and the performance that they have had. So this was taken over 2 dates, December 19 to June 20. And I would strongly recommend that each of you pick one scheme and you look at one year growth rates of these 2 different schemes. You will find, you'll be able to find it if you just type the name of the mutual fund scheme. You should be able, first of all, just Google mutual fund schemes. You'll get a number of schemes. Take those schemes and try to find out what the growth has been. If you go to the company's website, they will tell you what the growth has been, what the NAV has been. Do this as an exercise after today's class. It will help you. I'll also put it in WhatsApp so you can have a look at it. And so look at this, SBI Mutual Fund, assets under management, 352,632 crores. I have a feeling there is a mistake. It should have been lakhs here because crores is a bit too much. But in any case, if you take this figure, in December 19, this was 352. In 6 months, it had increased to 364. There was a positive change. In these 6 months, this mutual fund had made a growth of 3.3%. HDFC Mutual Fund had a negative growth of minus 6.88. The total assets that it had was 382,517. It actually went down because the share prices of the companies in which they had invested in went down. That went down to 356,183. So they had their assets declined instead of going up. So in this case, what will happen? If you have invested in HDFC Mutual Fund, then it will actually, your capital is reduced. If you had invested a certain amount of money, your capital is reduced. Let's say you had by about 7%. If you had invested 100 rupees, your capital left is now 93 rupees because you have lost 7%. Now, why is this period very, very interesting? Because this is the period when Corona came in March 20. So when that came, the performance of companies actually deteriorated. And as a result of that, you had this position where there was this decline in the asset value. So some of the mutual funds have, even under these circumstances, managed to do very well, at least decently well. You take the case of SBI, 3.3% in 6 months. If you analyze this, it is 6.6% per year. But who knows whether in the next 1 year it will go to 6.6 or 16.6 or -2. You don't know. Axis Mutual Fund is the best one here, which has actually grown by 9.32% in 6 months. So are you understanding this, all of you?
Yes, sir.
Yes, sir.
So one question which is there in your mind, how good are mutual funds? Do they make high profits or not? I think if you have a look at this, you are getting some idea. Now, if you go back and do some work on your own and look at the returns of different mutual funds today, you will find a lot of them. You don't have to actually look at each mutual fund. In many sites which you find, you will find it all there for you. The complete list, performance during the last 1 year, and you will see different sorts of figures there. And all those figures will look very good. The point I'm trying to make to you is, it depends on the start and end date. See, suppose you December 19 to June 20, it is, let's say, in SBI is 3.3. Now, if you take June 20 to June 21, this figure will be absolutely different. It will be very high. If you take June 21 to, let's say, December 21, it will again be a third figure. So it is very difficult for you to simply understand the performance of a mutual fund on the basis of these figures. This is the point I'm trying to make. And that is why it is difficult to choose. Okay. Let's understand some of these words now. We have this concept of assets under management, net asset value. So any thoughts on this, assets under management? Okay, what we'll do is we'll take a 5-minute break and then we'll come back to this. Is that okay, everyone?
Yes, sir.
Yes,
Okay.
sir.
Tanya was, I just admitted Tanya, again she's out. Shruti, what are assets under management?
Sir, I do not have any idea about this.
No idea. Okay. Paresh ji?
So assets under management, the charges which investor has to pay.
No, that is expense ratio.
That is expense ratio. It must be for availability of fund which that fund manager have to invest.
No, it's like this, very simple. Let's say that 1,000 people, everyone gives 100 rupees each. They buy units in a mutual fund. There are 1,000 people, all of them give 100 rupees each. The fund manager gets 1 lakh. Now with this 1 lakh, let us say that he buys shares of 5 companies. And when he buys this, the total amount which he invests in this is, let's say, 90,000 rupees. So on the day he buys it, on that day, what is the value of the assets that he has bought? It is 90,000, because he has bought the shares of those companies for 90,000 rupees. So basically, that is the asset under management. Now, let's say that tomorrow the price fluctuates and the share prices all go up. And let's say after 6 months, you find that the total value of those 90,000 which he had, the shares which he had bought with those 90,000 rupees is now 1 lakh. Then you will say that the assets of the company managed by the company are now valued at 1 lakh. You understand this? It is basically whatever has been bought with your money, with the money of the investors, whatever assets the mutual fund has bought, that the present value of those, not present value, the current market value of those assets. I don't know why Tanya is not managing. Tanya, are you with us now? Okay. Tanya?
Yes, sir. Yes, sir. I have joined.
Okay, fine. So you were discussing assets under management. So how do I understand assets under management? So mutual funds invest in stocks by buying shares. I'm taking one type of mutual fund which is investing in stocks, just as an example. Let's be clear, this is not the only asset class in which a mutual fund will invest. So stocks bhi le sakta hai, bonds bhi le sakta hai, it can buy different types of things. But right now, as an example to explain assets under management, I am just saying that let us take a mutual fund which has bought the shares of different companies. Okay. Let's say that they have invested the money that you gave them in the shares of 40, 50 companies. So what are the assets of this mutual fund? It is these shares that they have. Remember, when we look at the asset, the balance sheet of an individual, suppose I were to ask anyone to give a balance sheet, his personal balance sheet, he will tell you, okay, I have a flat, the flat has a value of 5 lakhs. This is one. Number two, I have made investments in fixed deposits. That has a value of 5 lakhs. This is 2. Number 3, I have bought shares of Tata Motors and Infosys. The market value of these today is, let us say, 50,000 rupees. That is another asset. Now, in the case of a mutual fund, the assets in this particular case are the shares which the person has bought, the stock the person has bought in the company. So let's say that these are his assets. Now, they manage these assets. Remember, you are giving your money to a fund manager. So he is managing these assets which he has bought with your money. So therefore, it is known as assets under management. Now, if you obtain the current market price of each company's share and multiply it by the number of shares the mutual fund has, you will get the total. That total that you get is the asset value, the total value of the assets being managed by the mutual fund. Therefore, the term assets under management. Is it clear now? Paresh ji, Shruti?
Yes, sir.
You understand now? So this concept of assets under management, this is the short form is AUM. So you will find this word AUM used quite often. It will be there. And so this is one. Now we'll talk about the other one, net asset value. So any idea about this net asset value?
No, sir.
No, you know this, Paresh. The only difference, do you have an investment in a mutual fund? Any fund?
Yes, sir.
Then you know net asset value. It is just
Sir,
you may not.
It's a NAV. It's a NAV.
NAV.
Means what we
sir,
can
can I try?
say.
Paresh ji, what were you saying?
Value
After
per
that,
unit.
you say.
It's a price per unit value.
The per unit value. Okay, Shruti, you?
Market price minus the initial price that we bought.
No, not like that. What you are saying is market price minus the initial price. No, not like that. There are certain things which are minus, because that concept, your mind is very clear. The word net is there, so something is being reduced. Basically, whatever liabilities the fund has, that is being reduced. We'll look at that. So the total asset value net of expenses per unit of the fund, and is calculated by the AMC at the end of every business day. So first of all, they will calculate this, the assets under management. This is the total amount of assets that they have. And then from that, you have to reduce all the expenses that has been incurred. Because for the day-to-day management of the fund, it will have employees, it will have investments in, so it will be paying rent, power, the usual stuff. All that will be there. It will buy servers or computers. It will have office equipment. Then there will be fees which have to be paid to brokers for buying these things. There are different fees to be paid to the registrar. Lots of expenses are there. Who will pay for those expenses? Obviously, it has to come out of what is, that is what Paresh was referring to as the expense ratio. So the value of all the securities in the portfolio is calculated daily. Portfolio is that collection of securities that the mutual fund has. So if we take this example and we say that it has investments in 40 or 50 companies, then that is its portfolio. This investment in 40, 50 companies. And from this, all the expenses that it has incurred in managing the fund, that is reduced. So let's say it has a total 3,000 crores is there as the assets under management. And let's say they have spent 10 crores on actually managing it through employees and the expenses on employees, the expenses on overhead costs, etc. The commissions that they have paid to brokers, all that you take into consideration. Let's say it comes to 10 crores, the actual value was 3,000 crores, then the net asset value will be 2,990, 3,000 minus 10, and that divided by the number of units that the fund has. So total assets, including current assets, minus current liabilities, whatever it has to pay, divided by the total number of mutual fund units. So initially, when you invest in the mutual fund, let's say mutual fund is just starting up, and you invest, let's say, 1,000 rupees in that fund. And let us say, just for the sake of example, that the per unit value is 10. When they are starting, they say that each unit in a fund you can buy for 10 rupees. You have given them 10,000 rupees. That means you have been given 1,000 units. Now, so many other people like you have also bought units in the fund. You total up all these units. So these units that they have, that is your denominator. On top of that, you put the total assets that the fund has, all the, the values of all the assets that it has minus the current liabilities, whatever it has to pay. all those fees and rents and salaries, etc. And whatever you get, you divide that by the number of units and you will get the net asset value. Is this clear?
Yes, sir.
So when will the NAV increase?
When the shares price will increase?
Yes, when the share price will increase. Then because the expenses will remain the same. Now. The expenses side will not change. There is a certain fixed overhead expense in running that fund. And see, one very big part of the expense will be the fund manager himself. Since that fellow is the star, that chap is being paid very big amounts of money to manage your fund, crores of rupees. So one very big part of the expense is he himself, this fellow. And apart from that, all the establishment and overhead costs are there. So all that is going to be the real change is the share price. That will change. Okay. Now let's talk about this expense ratio. So every mutual fund incurs expenses in managing the fund. This is the part where we understand the net part. What are we reducing? What are these liabilities that the fund has? So the expense ratio measures the per unit cost of managing a fund. The total expenses divided by the number of units. So a 1.5% expense ratio means that the AMC, the asset management company or mutual fund, is charging 150 for every 100 rupees of assets under management. So if the total assets are 100 crores, then that means it is charging 1.5 crores as the fee, expense ratio. Now, as per SEBI, you can have a maximum of 2.5% for equity funds and 2.25% for debt funds. Now, the logic of having more for equity is that since equity is volatile, so you would maybe require more staff to handle it. So your expenses are going to be more because of that volatility. Think of it like that. There is more work to be done if the investment is made in equity, because to protect the interests of the investors, you will have to make sure that everything is being done in a you'll have to keep up with the market. Whatever changes there are in the share prices, you'll have to take quick decisions with regard to selling the shares, buying new shares. If you do this, you will pay more brokerage. That will again push up the expenses. So there are a number of things to consider. Maximum base 2.5% for equity and 2.25% for debt. So that means if the total assets under management are 100 crores, SEBI is allowing you to charge up to 2.5 crores as an expense. If it is 200 crores, SEBI will say that again 2.5 maximum, up to 5 crores you can charge as an expense. So as the fund size increases, the amount which is available to you, the maximum amount which is available to you as an expenditure, that also increases. That means that you can pay more to get better staff. You can pay more to get a better fund manager. Those things will be there. Okay, then it includes the management fees paid by the AMC to fund managers, transfer agents, custodians, legal fees, marketing and distribution expenses. See, mutual funds advertise. Mutual funds sell their units through a network of brokers. They sometimes sell it through banks. All these people have to be paid commissions. The transfer agents which are there who transfer the shares from to the mutual fund every time it buys something, it back to someone else who buys the funds who buys the shares from them when they sell it. So there are lots of payments to be made. So you take all these expenses and on a daily basis, you are expected to reduce these expenses from the total value of the assets that the fund has. And every 6 months, they will disclose this. What are the expense ratios of the fund? So even if you today, if you Google this or go to a website of a mutual fund, try to find out, you will get some details about this. So it's pretty transparent how much they are charging. And so the simple thing is that the higher the expense ratio, the less money there is for distributing to the investors. So that point is there. This is probably why when I was saying what is the disadvantage of investing through a mutual fund, Paresh ji immediately pointed out that the expense ratio is a excuse me, the expense ratio is an important aspect of that. Is this clear to everyone? So by now you should understand assets under management, net asset value, and expense ratio. See, these three things are necessary for you to make an informed decision about the decision to invest through mutual funds. Any doubts, anyone, about these? All clear, Tanya?
Yes, sir.
Okay, no doubts, no? Sure. So next time I ask a question in the quiz, you have to get it correct.
Yes,
If I find at that point that you don't get it correct, then there'll be a penalty. Okay, now we come to another aspect of this, types of mutual funds. So this is again a very, one way of understanding, and it will partially answer your question, where should I invest? In which mutual fund should I invest in? So the first thing to remember here is, if you look at you can take mutual funds and you can actually categorize them by structure. So the structure is, there are basically two types. One is open-ended and one is closed-ended. So open-ended schemes do not have a fixed maturity period. They are available for subscription and repurchase on a continuous basis. That means once the fund is started and investors come and give them money and they begin to buy, let's say it's an equity fund and they begin to buy shares of different companies, and they keep buying, selling, making profits, and the NAV keeps going up and down, all that is happening. Some investors will continue to stay with the fund. Some investors will redeem their investments. That means they will sell their units back to the fund. New investors will come in. So it's a continuous process and it will continue year after year. The fund is open-ended. That means there is no closing date to this fund. It will just go on. It's not it's only for 5 years, it's only for 6 years, nothing like that. The fund starts, it will continue. So, for example, that SBI mutual fund that we were seeing, whose performance was given between December 19 and June 20, it had a 3.3% growth. That is an example of an open-ended mutual fund. So it was there whenever it started. From that time onwards, that fund continues to function. Closed-ended, they will have a maturity period. They will say that we are going to be managing your money for 7 years. After 7 years, whatever is the total AUM that we have, we will take that money and return it. We are there for this period only. So they are open to subscription only during the period of launch. So there is no continuous buying and selling here. They can be bought and sold in stock exchanges where they are listed. Exit routes are also provided by the fund to repurchase at specific points of time. So basically what is happening is that when the fund starts, at that time you buy in that fund. And once you buy, you are locked in. You will not be able to sell it except at certain points when the fund will say that, we are willing to repurchase the units that you have bought. Those of you who want to redeem your money, who want to get your money back, they can sell their units to us. So this particular part of it, here what is happening is that it is functioning for a fixed period. So anybody has any idea about what type of fund does this? The only person who might have an idea will be Paresh ji, so I'll ask him. See, let me tell you right in the beginning, most of the funds that you are familiar with or which you have heard about, all those funds are open-ended funds. Closed-ended funds are generally tax funds, funds which are, investors who buy in these funds, they get a rebate in payment of taxes. But the other side of it, they will get that rebate, but they will lose liquidity for 3 years at least. For those 3 years, they will not be able to, that is the lock-in period of the fund. So if you, let's say, invest 1 lakh rupees in a tax equity fund, let's say a ELSS fund, equity linked savings scheme, which is basically a type of mutual fund, a scheme of a mutual fund. You invest, let's say, 1 lakh rupees out there, you will not be able to take this money out for the next 3 years. It is locked in. Lock-in period is there. After 3 years, you will be able to sell this. And maybe after 5 years, that fund itself will say that the fund is over, take your money back. The surprising thing is that these funds quite often have very good returns. There is no way of understanding or why they have better returns, but it has happened quite often that many of the tax mutual funds do very well. So everybody, I hope, is clear about open-ended and closed-ended.
Sir, maybe one of the reason they have a fixed amount for a longer period because they know that nobody is going to take
yes.
their money.
You're right. That can be that can definitely be a reason. There is stability. So there is stability out there, and so they are able to, they know that this money will not be withdrawn. And the other aspect is that their cost will be less also. Since they are not going to be, brokerage is going to be less, people are not going to be buying, selling so much. People don't expect them to, keep churning the investments. It's not that active as a fund. So they can take a long-term view about stock and maybe earn better. That definitely can be a reason. Another type of by structure again is a direct mutual fund plan. So here the investor invests directly with the mutual fund company, bypassing distributors or a platform. So it improves the return on investment of the investor by approximately 0.7 to 1% per annum as compared with a regular MF. So this is recommended for knowledgeable investors who self-invest. Going with this means that you will have to select the scheme yourself, go to the website of the company concerned, the mutual fund company, choose that scheme and invest. So that way what happens is, had you invested through a broker or had you invested through a bank, they would have taken a small brokerage. You will not have to pay brokerage in this particular case. But like it says here, this is recommended for knowledgeable investors only. That means nobody is helping you with the choice of mutual fund. Remember when we were discussing a bit earlier, we said that it is difficult to choose the right mutual fund. Now, if you're not very knowledgeable, you are new to this game, if you randomly select a fund, then maybe you will not make the best choice for yourself. But if you are willing to do that, you can actually go and invest directly, hope that you make the best choice, and in the process, you will save the brokerage, which will be there otherwise. Now, let's look at mutual funds from a different category, where they invest the funds. So remember, we said that mutual funds may invest in different types of instruments. So there can be equity funds. They will invest in equity. Debt funds, they will invest in debt. Hybrid funds, it's a mixture. Some debt, some equity, some other stuff. Bonds, government bonds. Solution-oriented schemes. This is actually solution-oriented schemes is not so much where they invest. It is, I think, more of way of marketing the fund. So let's say that they will have a children's plan. They'll say that, okay, why do we'll have a plan? You invest here, all those of you who want to create a fund for your children, let's say for the purpose of their education, invest here. It is just is not that it will do anything differently. It's more of a marketing way. And there are other schemes also. So we'll have a look at each of these right now. But before we do that, we should also try to understand this concept of large cap, mid cap, and small cap funds. So my first question here is, so when we say large cap, cap is basically an abbreviation of the word capitalization. So what is capitalization? What is this market capitalization? Anyone?
Number of shares the company has issued into the current market multiplied by the current market price.
Yes, absolutely. Very correct, very correct. So it will basically tell you that a company which has issued a certain number of shares, what is the total value of its shares in the market? That is the capitalization part. Now, what SEBI has done is that they have classified the companies based on their capitalization. That means by size. How much capital is locked up in the shares of your company? So arrange all the companies in descending order, all the bigger companies on top, all the smaller companies below. And what is the basis for arranging these companies? Based on their market capitalization. So let's say the Tata Motors has a market capitalization of, let's say, less than Infosys, then Infosys will come first, Tata Motors will come next, and so on and so forth. Everybody will keep coming based on their. So which are the companies we will treat as large cap? In that list that we make, the first 100 companies are considered to be large cap companies. Basically, it is based on the market capitalization. I take the top 100 companies in terms of market capitalization. In a different manner of speaking, I take my biggest companies. So when I say big, I am actually referring to this market capitalization aspect. I take that and I say that yes, these are large cap companies. Then the next thing will be mid cap. So I take from 101 to 250 in the same list. 101 before up to 100 was large. 101 to 250. These will have less market capitalization than the 1 to 100, obviously. These will be basically my mid-cap companies. And all the companies from 251 onwards will be small-cap companies. So is this clear, everyone?
Yes.
This is basically the concept of market capitalization. And this list, if you go to the AMFI, Association of Mutual Funds of India website, you will find that they will put this list there every 6 months. End of June and end of December, they will let you know exactly which companies are considered as large cap, which companies are considered as mid cap, and which companies are considered as small cap. So that's one thing there. Now, continuing with this, types of companies and where they invest. Now that we understand that there is such a thing as market capitalization, we also know that some companies are investing in equity. So within equity, it is possible to invest in large cap, small cap, medium or mid cap. So that's why we spoke about market capitalization before returning to this. Mutual fund companies by where they invest. So first of all, start with multi-cap. So these mutual funds primarily invest in stocks selected from all the listed stocks in the Indian market. That means here what will happen is they will allocate 65% at least to equity. And here they are not saying that we are only going to be investing in large cap, or only in mid cap, or only in small cap. They will invest across. Some of the money they will put in big companies, Some they will put in the middle companies, and some they will put in the smaller companies. Now, what is the reason for this difference actually? Why do you think they have made this difference between large cap and mid cap and small cap? Is it purely a statistical thing, or does it have more relevance? What is the reason for this?
Sir, I believe it has relevance because the large cap companies have higher market price. The market price of the shares have grown.
That is not necessarily true also, Shruti, and that is not actually the main reason for the difference between why they have these different. So there are, let's say, very big companies, there are middle companies, and there are very small companies. Think more in terms of how much information do you have about each category of these companies. So companies which are very big, which are always in the news, you will find that these companies, a lot of information is available to you about the company. Quite often, whenever they take a decision, it is flashed across in the newspapers. It is there. You will see it on TV. There will be discussions about it on CNBC and other such channels. So there is a lot of information that you have about the company. Also, because the company is very big, it is considered to be more stable. So to grow big, obviously, the company would have been in existence for a long period of time. So let's say they have more experience in managing their whole affairs. Maybe their market share is also higher. So the chances are that the company's growth is going to be pretty stable. It will not actually be fluctuating too much. It will be, the share prices may fluctuate, but the company itself will be a company which is doing well mostly. The growth is steady. The management quality will be good. It will be professionally managed. It will have a large amount of experience on the basis of which they can take decisions for the future. So there are a number of good things which are there about large cap. All these things which I mentioned, the better management, the greater experience, the large body of capital that they have, all that also means that maybe when I invest in a large cap, in the long run, my risk is less. Risk is less in the sense that, see, whenever we say invest in a good company, keep it there for 20 years, which companies are we talking about? We are talking about the large cap companies. Why? Because we feel that these are safer. Why do we feel these are safer? Because they seem to be better managed. They are more, their revenues are stable. They have a certain market. The money is flowing in on a regular basis. If they keep improving their products, if they keep moving step in step with technology, all what will result is that they will continue to keep doing well. So basically, these companies are really going to do, they'll be fairly reliable that way. Now, the moment you go to mid cap, you will find that the scale is smaller. So once again, they will also have experience, they will also have professional management and all. But the thing is that here, maybe there will be less stability in these companies than in the large cap. So if I look at it from that aspect, it also means that maybe they have a smaller market share also. It also means that going forward in the future, they may not be as stable, as reliable as the large cap company. So if you begin to give points on reliability, on stability, on strategy and all those things, probably you will find that these companies represent slightly higher risk than the large cap. And the small cap companies are basically still new to the game. They don't have that body of experience which was there in the case of mid cap and which was there in the case of large cap. So these companies essentially are smaller companies. They will be, their share prices are going to be volatile. their decision making is going to be not maybe as steady as the bigger ones. So your risk is higher. So that is one of the big reasons why, this, when we invest in larger companies, we probably expect to, our money will be safer. Maybe our returns will not be as high as it will be in a small cap. But in the small cap, the risk is much higher. So the usual trade-off between risk and return, which we have been discussing all along, that will be there in this case also. Is everybody clear about this point? How we relate the size of the companies with revenue stability and with risk.
Yes.
Yes, sir.
So if I want to go for a mutual fund, and the mutual fund is telling me that we are going to be investing in small cap, what does this tell you?
High risk, high return.
Yes, high risk, high return. So in that particular case, if you invest in that small cap fund and you put a good bit of money, and then after 1 year you find that your capital has gone down actually by 7-8%, you should not be surprised, because that can happen. On the other hand, if things go well, then it is also possible that you will make a 20% return or a 30% return. You take that Quant mutual fund, that huge return that it had. That is something which will happen occasionally, but it will not happen always. So by understanding the concept of capitalization, I am beginning to understand one type of mutual fund. So when I read that a mutual fund is investing only in large caps, the first thing that should come to my mind is that, okay, this is not going to do very badly. It is also not going to give me very high returns. But maybe this particular investment of mine, at least it will keep my capital safe as compared with small cap. So if I go for multi-cap, I am trying to mix all three. So I am trying to also have some stability in my portfolio, also have a better return on my portfolio. I'm willing to take a slightly higher risk with part of the money that I am investing, because that money is going into a small cap. Large cap fund, minimum 80% of all assets in large cap companies, they will invest. And like we said, that these are the top 100 companies. The scheme will definitely possess low risk, will provide modest returns when compared with mid and small cap. So the reasoning which I had given you a little earlier, that is the basis for making this statement. The scheme possesses low risk because you are investing in companies which by nature are big, experienced, stable, accepted by the market. So here your risk is going to be less, and modest returns when compared with mid and small cap companies. The returns of the large cap is going to be modest or less when we compare it with mid and small cap. Mid and small cap will be, let's say, companies which are, like we said, which are not as big, but where the share prices tend to be more volatile, because investors take a chance on that. So lots of large money coming in, large money being pulled out, share prices keep going up and down. So if you have a very smart fund manager, and if he actually manages to time the market correctly, he will make some money. But like they say, you should never try to time the market. It's not worth it. You will get it wrong most of the time. Now, a large and mid-cap fund, so minimum 35% of all assets in large and minimum 35% in mid-cap. So 35 will go for large, 35% will go for equities, and the remaining 30% which is there, that you leave to the discretion of the fund manager. So remember, we are saying minimum 35. So it's not as if there is a cap that not more than 35. Minimum 35 is going there in large, minimum 35 in mid-cap equities. If the fund manager feels that more should go into large, then it's up to him to decide. You are, after all, trusting that fund manager to take the right decision given the market conditions. Now, these will be naturally slightly riskier than the large cap schemes because of the fact that part of your investment, 35% or more, is going into mid cap. Mid-cap funds, on the other hand, they will take 65% and put it into mid-cap companies. That is the minimum, 65%. The other 35%, they can decide what to do with it. But the 65% or more, the larger part of the amount which you invest is going to go into mid-cap. So since they are betting on mid-sized companies, the risks will be a little higher. But at the same time, you can expect to have a better return. Take more risk, expect more return, basic financial principle. Small cap fund, that same 65% now going into small cap companies. Definitely, here the risk is going to be high, and the returns can also be phenomenal. So that Quant Mutual Fund is an example, which is beyond phenomenal with 96% and 76% 2 years running. So fantastic job, but the risk was always there. So these are, when you look at a mutual fund, if you look at where it is investing, if you look particularly to see where they have invested, large, mid, small, you will begin to get an idea about the risk that is inherent in the fund. Because no matter how good the fund manager, a smaller companies are going to be riskier by definition. Because these companies will have less stability, less experience. And because of that, there will be a higher risk. So the fund manager may be very good, but if he decides to put his money in the smaller company, he is accepting the fact that there is a higher risk, and he is passing on that risk to you as an investor. So that you need to remember that part. Now, we look at equity. We're continuing with this part, the dividend yield funds. So basically here, what is happening is, let's say that people who are like me, who are no longer in active service, who have retired, and we want to invest in a scheme, in a mutual fund, which basically gives me, let's say, dividends. I'm able to get a small income from my mutual fund. So in that case, the mutual fund will have to also invest in companies which are regularly giving dividends. Only then, because when a dividend is given, that increases the value of the total assets under management. If the assets under management was 3,000 crores and the company receives a dividend of 100 crores, then the total assets become 3,100 crores. That is the point I'm trying to make. So it will increase the amount that they receive, and they will distribute this to you. So for many people who are looking for a regular income from a mutual fund investment, this type of fund is going to be more relevant. So here I'm not looking at large cap, mid cap, small cap. I am looking at companies with one criteria: do they pay dividend or not? Are they regularly paying dividends? If they are paying dividends, I will buy the stock, because then I will get dividends, and then I will be able to give my investors a regular income. Then value fund. So this concept of value investing is that the fund manager will look at companies which are not necessarily trending. These are not companies which are in the news, but which he feels are very good companies, but have not been noticed by the investors, have not been noticed by analysts, not been noticed by the market. And as a result of that, most people are not buying the shares of these companies. And as a result of that, the share price is low. But what the fund manager is betting on is that these companies actually have a lot of value. They're going to do very well in the future. So he will invest in companies which he feels are undervalued. The share price, let's say, of this particular company is 55 rupees. And he feels, no, this company in the days to come is going to do much, much better. It should not be 55 rupees. It should be at least 75, 80 rupees today. And going forward, this is going to do much, much better. Because maybe it is in a line of business which is very good for the future. The market hasn't realized this, but I, as a good fund manager, I'm seeing this. So I will say that, okay, I will put the money of my investors in this particular company, which I feel is good and which I feel is undervalued. So the main benefit is, if it is undervalued, it means that the share price is low. So with the same amount of money, I can buy more shares in the company like this. If I buy more shares and tomorrow this company really does well and the share prices go up, then I make a good amount of money for myself and for my investors. That is the logic. This concept of trying to identify undervalued companies and investing in these companies, basically this concept is known as value investing. So you are being able to see the value in a company which others are not seeing. And since others are not seeing it, they are not buying shares in the company. And as a result, the share prices are low. Has everybody understood this concept?
Yes, sir.
So if you have understood this, then in that case, my next question will be, if you invest in a fund of this type, how do you feel it will be a short-term investment or a long-term investment?
Long-term investment.
Because you must give time, for the company to perform well. The market should begin to see the company is doing well. Market should begin to take interest in its shares, and only after that is it possible for the share prices to actually rise. And once it rises, of course, the mutual fund does well, and then you make a lot of profit. This focused fund is not exactly very different. All that it is saying is, it will be very similar to a multi-cap fund, but basically what it is saying is that we will not go and put our money into a large number of companies. So some mutual funds may be, having 50, 60, 70 companies in which they are investing for the sake of diversification. So these guys will say, no, let's focus on 30 really good companies. We'll only put our money there. That's why it's called focused investing. So the level of diversification is less, but at the same time, you are betting on a certain small number of companies who, in your opinion, are going to do very well. So if your basic selection of these companies is correct, then in that case, your investors are going to make a lot of money. That is the point here. So then you have this concept of a contra fund. Contra means ulta, contrarian. If everybody is going left, I will go right. If everybody is going right, I will go left. So I will invest in equities. So this will be very, very similar to the value fund. But they use the word contra fund. See, many of these words which are there are used, fancy words, which are used basically to attract your attention. What they are saying is that we will not be guided by herd mentality. जो सब कोई कर रहे हैं वो हम नहीं करेंगे, हम अलग हो जाएंगे सबसे. फायदा क्या होगा? If I go walk a different path, if I begin to invest in companies which other people are not, the market is not recommending, these are not, trending stocks, then in that case, the chances are that the prices of the shares of these companies will be low. And if that is the case, then I will be able to buy more shares with less money. And in the process, if I am right in picking these companies, my assets under management will increase as when the share prices go up. And in the process, my investors are also going to make a lot of money. So we will stop the discussion here and continue tomorrow. Any questions up till now?
No, sir.
No, sir.
I hope you're getting a better idea about mutual funds now, about what mutual funds do and how they are managed and how they invest. So tomorrow we will, of course, complete this. And then in the last, so 6 hours are there, 2 hours today, 2 tomorrow, and 2 next Saturday. So, and in the last part, we'll also try to look at the performance of funds today. And here, next time, tomorrow, I'll give you a small assignment for the weekend, which you can do. And we will look at whatever you come up with on next Saturday. So, okay, good night for today. And Thanks for coming in, and I hope
Thank
you
you, sir.
enjoyed that. And I hope all of you, your families and everyone is safe. Omicron has not managed to disturb your lives. I hope all is well. Stay safe.
Thank you, sir. Thank you.
Thank you, sir.